Brian might be buying if you found the right deal. That's pretty cool. You weren't saying that 2 years ago. That's
I
pretty cool.
wasn't. 2 years ago, what I said was when I would get a new deal in my email inbox, I couldn't hit the delete key fast enough. I didn't care what it was. You can keep it. Yes, this is a change. You heard it here first.
Brian, welcome to the show.
Hey, man. Great to be here. Thanks.
So you were, I said 2.5, maybe even 3 years longer. You were, because you and I have known each other for a little while. You've been a bit of a skeptic on the multifamily space, so much so, in fact, that you stopped buying and then you started selling. One of the few people who did both. A lot of people actually did the same exact opposite. And I was wondering, at the time, 2, 3 years ago, what did you see at the time that you didn't particularly like that kind of made you step on the brakes a little bit?
I saw what I could best describe as irrational exuberance, I think is about the only way I could put it. I saw anybody and everybody becoming a multifamily investor. I saw everybody that was a multifamily investor paying incredibly high prices. It gets to the point where you're like, would I buy that asset for that price? Would I buy my own asset for the price that somebody might offer me? The answer was no. I was also seeing that as I was trying to acquire additional properties, I would get outbid by millions of dollars. And each listing that came on would get dozens of offers, and many of them with 6 to 7 figure non-refundable earnest money deposits at the signing of the contract. And when you have that much enthusiasm for a market, it's oftentimes an indicator that the pendulum has swung too far and it's going to swing back the other direction. So that's kind of when I made the decision that if there's people out there that really want these assets and they really want them at these prices, who am I to say no? They might as well take all of mine as well. And that's when we started selling.
Was there anything around, so was it more of a feeling, I suppose, that you were getting around? And I remember the time very well, and exactly what you're describing, non-refundable deposits, multiple bids above asking, things of that nature. It did feel like it was towards the top of the market, but sometimes these markets can go on for a while. Is there anything that when you said these high prices, I mean, is there anything besides the absolute dollar amount based on what you bought? Anything else that you saw with regards to cap rates or any other economic indicators, anything about the economy where it kind of made you put the brakes on?
Nothing about the economy. In fact, this is what was interesting about this market shift is fundamentally, housing was a very solid investment and still today is a very solid asset class. Housing is really, in my view, the best asset class to be in, especially over the long term. So this is what gets really difficult at times like 3 years ago was when all the fundamentals are saying that this is great, there's a lot of support to make the decision to liquidate is very difficult. And I could have been wrong. I mean, it's possible that this market would have gone on for a long time, but it already had. See, this was kind of part of the decision making was that we were in the midst of I would say 11-year bull run, maybe a 12-year bull run. That's one of the longest bull runs I've seen in my 35 years in this business. And when you watch what's happening in the market with investor sentiment, usually like right at the end of a cycle, the sentiment rapidly accelerates. So let's say everybody's pro multifamily, and this goes on for 5 years, and they're still pro multifamily, and then 7 years, still pro multifamily. And then you get to 10 years, and now you're not seeing pro multifamily. You're seeing like, I gotta have it. I gotta get into it. This is my only shot. If I don't get in, I'm gonna get priced out. I'm never gonna get in. And there's this like the enthusiasm gets amped up by a scale of 2 or 3x in a very short window of time. And this is what happened right after COVID. And so as soon as there was this like COVID lockdowns, everybody started to like retrench, like, oh, wait a minute, is this going to be really bad? Is the party over? But then very quickly, there was this rush of demand to get into multifamily, and that created an intense rush of investor sentiment. If I were to look at uh, objective indicators, things that you can quantify easily, such as interest rates, cap rates, job growth, population growth, this is the various things that you can access numerically. The scores were all in favor of investing. I would say maybe the only one that really wasn't at the time were cap rates. Cap rate compression means that anybody that owns real estate is making money, because as cap rates go down, that means prices are going up. And that means if you already own an asset, you're doing quite well. But it makes it very difficult to acquire additional assets as these cap rates get more and more and more compressed. So when you start to see the delta between interest rates and cap rates erase, and you see, stuff trading at 3.5 caps, there's no compression left. And so, kind of like when you're blowing up a balloon, it gets bigger and bigger and bigger, but there's a point where you can't blow that balloon up anymore without it bursting. And this is kind of what I was seeing with cap rates, is they were getting compressed and compressed and compressed. You can't go to 2 or 1. So where do they go from 3.5? Where do they go from 3 3/4? Where do they go from 4? Really, the only place they can go is level or up. And up means declining prices. Enthusiasm means that they're artificially compressed. And when you kind of combine all that stuff together, we saw a real opportune time to sell.
That was a good answer. Real quick. So when I ask you a question, because we're gonna make you talk without me, kind of summarize my question as if I didn't ask it.
10-4.
Otherwise, so it might sound a little weird, but I don't think so. It's just you're actively listening. Something I
Yeah,
don't.
sure. Yeah, I got it. I got it. Okay, will do.
So that's really interesting, Brian. So what do you think has changed, if anything, now versus 2 to 3 years ago?
Things that have changed in the market are investor sentiment to a degree. Uh, there's a little bit less buyer enthusiasm, although I would say it's still too high for where we are in the market. Uh, Sellers' attitudes have certainly changed. I would say 3 or 4 years ago, sellers really thought their property was worth more than it was, and buyers agreed with them. Now, they still think they're worth more than they are, but they're finding some buyers that are agreeing just enough to keep a little tiny sliver of transaction velocity going. So I would say there's a little bit more realism on behalf of maybe long-term owners who have had their properties for a while. They've appreciated quite a bit. They saw the peak, they missed the peak, but now they're saying like, okay, if I want to sell, I can sell and I've made a really good profit. Short-term owners, I'm not seeing the same dynamic, right? Short-term owners are upside down. The property's worth less than their loan amount. They're panicking a little bit. I think that's another thing that's probably changed in the last 3 years, is now you have some sellers that are getting really nervous about what the future holds for them. In other words, like, am I going to be able to keep this property? Is my loan going to mature before I can sell? A little bit of worry is coming into the market. There was a famous Warren Buffett quote that says to be greedy when others are fearful and fearful when others are greedy. And, several months ago, maybe even a year and a half ago or so, people started saying, like, well, everybody's getting fearful, so this is the time to buy. But in my opinion, it really wasn't, because what we were seeing at that phase was buyers were getting fearful because they weren't sure where interest rates were going to go. Buyers were fearful because rent growth was slowing down. Buyers were fearful because they weren't sure if they'd be able to raise the capital to acquire the property. But sellers weren't fearful. Sellers were like, "Hey, my property is 92% occupied. I'm getting my rents. I've got 2 years left on my loan. I've got nothing to worry about." Well, fast forward 2 years, now their loan's coming due. Uh, Now interest rates are even higher. And they're like, well, what am I going to do now? And sellers are just now starting to get to the point where they're becoming fearful of what their exit is going to look like. And when sellers become fearful is when the Warren Buffett quote really comes into play. Is that's the time to buy. The time that buyers are fearful isn't the time to buy. It's when sellers are fearful. That's the time to buy. I think that's probably the biggest change in the last few years.
Yeah, so true. So what do you think right now? What do you think is now a good time to buy? That obviously we try not to time the market, or, well, maybe we do. If one were to try to time the market, is now a good time to get in? Are we close to the bottom? Are we outside? Are we have we round the corner? Like what is your outlook over the next, 1 to 3 years?
Well, I think determining when to buy is probably one of the most difficult assessments you can make, right? You're trying to figure out when has the market shifted from a declining value phase of the market to level, or even better yet, an increasing value point in the market. And this is measured kind of in the same way that you would look at when the market is peaking, and just kind of using the opposite. When buyer sentiment reaches its lowest, that's when you've really reached the bottom. When and if you ever hear the buyers en masse saying real estate's toxic, it's not a good time to buy, you can't raise any money. Passive investors who might invest in apartment syndications are saying like, look, I just had a bunch of losses in these other syndicates. I'm not ready to invest in this space right now. Those wounds are still healing. When you get to that phase of the market, that's when you're reaching the true bottom. When no one wants to give you the money is really the best time to be buying. We're not quite there yet. Now, what we have seen is we've seen a bottoming of transaction velocity. Uh, Multifamily transaction velocity is down 70, 80, even as much as 90% in some markets. It's the lowest it's been in decades. And that is an indication of the disconnect between buyers and sellers not being able to get on the same page. As the market continues to mature and flatten out and start to reverse, then you'll start to see buyers and sellers getting on the same page, because sellers are going to have no choice. They have to get out of the property before the lender takes it from them. And when there's not a lot of buyers to take it from them, that's going to be a really good time to buy. And I think we're not quite there, but I think we're getting closer. Now, I would say one thing to think about as you're kind of observing the market as to when to get back in addition to watching what sellers are thinking and what passive investors are thinking, watch for objective indicators like a reversal in rent growth, uh, an expansion of absorption, a reduction of construction. These are other things that are going to be indicators that the future is going to be brighter for you. When you start to see fewer new product deliveries, that means less apartment availability in the market, less competition. That's going to mean renters are going to be aggressively pursuing what inventory is available like it used to be a few years ago. You'll see rent growth come back. That's going to be a really good time to buy.
A lot of things you described, I feel like we've already seen, specifically the sentiment around our passive investors. Anyone who's in those legacy things, they're not investing in any more multifamily. I mean, we have literally, or we used to have a repeat investment was like 55%. That dropped to essentially zero when this whole interest rate thing went. And we are now, for the first time, seeing some of those people coming off the sidelines again, like a handful who are coming back off the sideline. So the sentiment on the passive side has been awful, just absolutely awful. And having to deal with, repeated bad news, not only from us, but from other investments that they were in, reading the news. It's essentially like we and some of our peers have had to start over again. And so the majority of the investor capital we brought in is all new investors who've never invested in multifamily before. And so I don't know how much worse. I almost feel like it's gotten really worse. I'd say 6 months from a sentiment perspective was for us probably the absolute worst. And it's gotten a little better. But so it feels like to me we are from a sentiment perspective close to the bottom. Like if we can't raise whatever we raised before, now we can't buy that kind of whatever 40, $50 million property where now we're buying, 10 or $15 million properties. I don't know. It definitely feels like we're bouncing around the bottom somewhere from a sentiment. And I find it interesting, Brian, that you're paying a lot of, as much as of a data guy you are paying attention to a lot of the sentiment, the feeling that's out there in buyers and sellers. I like your distinction between both the seller sentiment and the buyer sentiment. Um, Talk about more some of the macroeconomic factors that you're seeing specifically around absorption. I think you talked about demand for rent growth, maybe even interest rates. Some of those factors that are maybe above and beyond the sentiment from a more macroeconomic standpoint.
Yeah, I would agree with you that sentiment has been falling dramatically over the last few years, in large part because many current passive investors have felt pain in their portfolios with a variety of sponsors. Bad sponsors are getting foreclosed, criminal sponsors are getting exposed. Good sponsors are seeing challenges in their portfolios. No one has been immune and really escaped from this. And this is what I talk about in my book, The Hands-Off Investor. I just recently rewrote a chapter for that book in its new release that's coming out soon that talks about market failures, or actually it talks about syndication failures. And there's really three different kinds of failures that occur in syndications. The first kind is a market failure. And a market failure is when what we're seeing now, when the market is not cooperating with the business plan. And the next kind of failure is a structural failure. A structural failure means the thing was kind of doomed from the outset. They got bad financing, too high a loan to value ratio, paid too much for the property, whatever kind of structural failure. And then the third kind of failure is a sponsor failure. And this is where the sponsors were incompetent uh, or were inexperienced, or the partnership failed and broke up. There's all different reasons why there would be sponsor failures. So what we see when there's a market failure, though, is a market failure tends to expose the other failures. And, they always say like a rising tide lifts all boats. And that when the market is really strong and good, even if your syndicate wasn't really structured well, or even if your partnership or the sponsor group wasn't a really strong partnership, when the market is great, they can just sell at a higher price a couple of years from now and they escape any kind of injury from the failures that were underlying that never became exposed. But when the market goes down, all the other kind of failures become exposed, and these things start to become very challenging for people. And so a lot of sponsors have failed completely because they had all three failures, and some of them are finding themselves in a lot of trouble, and that's really concerned passive investors, and that's affected sentiment very, very much. But even good sponsors still will feel a market failure. Now they may survive it because it's not happening at the same time as a structural failure or a sponsor failure, but the market failure was still causing difficulty for that syndicate and the passive investors that are in it. So I agree with you that passive investors that are funding all of these deals have become nervous, and rightfully so. But there are other things to look at in addition to sentiment. Uh, and there's more objective indicators like construction, for example. Uh, we were at record high construction. Over the last year, more apartment units and more housing units were built and delivered than at any time in decades, if not even in history. It's an incredible number of units. And that was driven in large part by the enthusiasm that was in the market 3 or 4 years ago. Because remember, it takes 3 or 4 years to get these damn things from concept to reality. So, in all that enthusiasm that was taking place years ago, is now manifesting itself in new apartment deliveries and new housing deliveries today. And so we're still kind of in this hangover phase. What we're starting to see now is permitting has declined substantially. Permitting is a leading indicator to apartment deliveries that will come in the future. Permitting is down dramatically, at least by 50% and by higher percentages in some markets. That means that soon we're going to see fewer and fewer deliveries. Now, we thought that, or a lot of people thought that the apartment delivery surplus was going to be, old news come end of 2024. This was all going to be over with. They were all going to get built in 24. And there was a saying that came out amongst a lot of apartment owners. They called it survive till 25. And it was under the hope of two things happening. One, that new construction would be done for, and the other was that interest rates would go down. And, I hate to rain on anyone's parade, but survive till 25 is an outdated saying. I think now you need to have something like, it's going to suck till 26, or I don't know. We got to think of a new rhyme. I'm not really sure. Uh, but what builders have found is that it takes longer to get these projects finished than they otherwise might have planned. Maybe it took longer to get the permits. Maybe it took longer to get the financing. Maybe it's taking longer to find subcontractors. But these deliveries are hanging over, and I don't think they're really going to significantly decline until at least the middle of 2025, and then they'll begin to decline. And I think by 26, we'll see reduced deliveries. So I think that's one element that you can look for. The other is absorption. Are new residents applying for available apartment units? And this is very market specific, as is construction. Now, let me make sure to be clear that there are markets in the US where no construction has taken place, and they're unaffected by additional apartment supply. But the markets that have been very strong in the past are the ones that are seeing the most supply. They also saw a drop off in absorption where tenants stopped applying for units because they weren't moving there as much as they were before, or maybe job growth kind of tapered off a little bit, or whatever was the underlying reason. That's starting to turn around. In fact, just this morning, I saw an article that came out saying that Atlanta's vacancy rate just had its first month-over-month decline in like 3 years. So we're just now starting to see where apartment absorption has made a comeback. Unfortunately, in the markets where this is happening, we still have a lot of deliveries. But as those deliveries taper, assuming absorption continues, we're going to see a return of rent growth in markets where those two factors collide. And I think they'll probably collide in the middle of next year, middle of 2025. So those are things to really look for. What is construction? What is absorption? And there's a metric out there that's a really good use for this. It's called the construction to absorption ratio. And you can look at this ratio to determine whether or not, if there's 100 units constructed, how many are being absorbed? If it's 50, we got a problem. If it's 150, then rent growth is near. I'd also be looking at interest rates, and we've had some declines in interest rates. The SOFR rate, the secured overnight financing rate, which is what floating rate loans are tied to, has come down about 3/4 of a point or so from where it peaked. The 10-year, that's a real problem. And this is where a lot of multifamily, like fixed rate financing, is tied to the 10-year treasury. And that's bouncing around. It's up, it's down, it's up, it's down. That's not helpful. So Does a decline in interest rates signal that the market's coming back? No, not necessarily. Interest rates could stay level, but pricing is going to have to come down to make deals pencil at higher interest rates, and that is another thing to look for. That last hurrah of price decline, so that we could then get back into the market with the reality of where interest rates truly are. So I'd be looking at those things more than anything. Rent growth is a great indicator. It's a lagging indicator to construction and absorption, but certainly a good indicator to be looking at. Monitor cap rates. They tell a story, but they don't give you an answer. But they do tell a story, so I'd be looking at that. Outside of that, just your typical job growth, income growth, and population growth. I've preached that for years. Even at your Dealmaker Live, I've said it 100 times. At Dealmaker Live, job growth, income growth, and population growth is what drives all income-producing real estate. Monitor those objective metrics as well.
So the big question is, Brian, are you actively looking for deals? Are you finding some that might pencil, and would you be prepared to buy?
I'm somewhat actively looking for deals. I'm monitoring the market, and we see a lot of stuff come in. Every day, I get opportunities that are being launched into the marketplace. I get calls from our broker relationships about off-market deals. We underwrite a lot of stuff. We just haven't found yet that everything is gelling. Now, I've long said that there's a needle in every haystack. And even in the midst of all the chaos that's going on over the last 2 or 3 years, there could have been and likely were really good deals to be had and found. They're just not very common, and they're very few and far between. And of course, everybody thinks theirs is the one, but very few of them truly are. Uh, if the right deal came along right now today, would I buy it? The answer is yes. Housing is a very solid investment fundamentally. I don't think that's going to happen right now, though, because if I'm being real about where interest rates are, where cap rates should be when I go to sell, in other words, exit cap rates, where rent growth really is, what expenses really are, which is a lot higher than they used to be, I'm missing the mark on a lot of these transactions. And there's other buyers out there that are successful and they're buying. I question whether or not acquisition success is going to translate to investment performance. That remains to be seen. Now, when pricing begins to come in line with all these economic realities I just mentioned, then it's going to be a really good time to buy. And frankly, I think at that point, there won't be too many buyers competing for it, which will mean that you'll be able to get stuff at valuations that are a basis that's actually reasonable given economic reality.
All right, well, you heard it here first. Brian might be buying if you found the right deal. That's pretty cool. You weren't saying that 2 years ago. That's
I
pretty cool.
wasn't. 2 years ago, what I said was when I would get a new deal in my email inbox, I couldn't hit the delete key fast enough. I didn't care what it was. You can keep it. Yes, this is a change. You heard it here first.